The bond bears are believing basically that inflation is here to stay and that we will see a very strong increase over the next month. Better, we should run for the shelters. Now, we don't believe so, because the reason what we see in the market are definitely not strengthening economies. We believe that the inflation will not increase, and if it will increase, very, very modestly. We believe also that a normalization of inflation and of interest rates will take years and definitely not months. The global bond yields recently went to their 5-month high. And we have also seen that global equities and high-yielding currencies have been sidewinding since August. Now, an asset class which is very sensitive to inflation is gold, and gold has been lurching down for the last 3 months. So inflation is so important because it has an impact on every and any asset class. The largest bondholders are banks, insurances, and pension funds. Now, if the cost of debt and the cost of money is going up, the impact is very widespread within our economy. When we look for the evidence of our views, we like to look at the US. Why the US? Because it's an economy which is the most advanced in its cycle. And normally, when you have full employment for such a long time, some inflation will finally come out. What we have seen is that headline inflation, which contains energy, will peak over the next 3 to 4 months. Now, this is not because the economy is extremely strong. It's simply a base effect and a reflection of commodity prices. Needless to tell you that oil was at its lowest this year in February. There is no meaningful inflation in the US simply because corporations in the US act today as if they were in a recession. Let me explain this. The bulk of investments of corporations flows into buybacks of their own securities or of some control units, not into physical assets. Now, if you buy back your own securities, you do not generate any productivity gains, nor do you change any economic growth. This is very important. The fundamentals today are not in place to see a revival of a very strong inflationary cycle. What we believe is that the Fed has very little impact while hiking rates on the longer-term bond yields. The Fed has finished their quantitative easing program 2 years ago and has hiked rates only 10 months ago. And still, we don't see any inflation in the economy. Now, in order to see some revival of the economy, probably we will need to see some budgetary stimulus and some fiscal loosening. And then we can see the economy jump-starting and inflation rising higher again. Now, what happens if the bears are right and indeed we move into a higher inflationary territory? Just one figure. The amount of debt of our economies is 152 trillion worth of dollars. So 152,000 billions. This is a bigger figure than before the Great Recession of 2008. We strongly believe that this cannot be sustained. The servicing cannot be sustained if we move away from these ultra-low rates. Now, this debt being at unprecedented levels and further rising, if we see an increase in rates, definitely this would cripple our economies. Our advice to investors is yes, inflation has been repriced. However, the reason for this repricing was purely a technical reason, because we have been moving our 10-year yields from all-time lows post-Brexit to the lower range of the pre-Brexit period. So do not panic. Now, I don't say that over time we will not see inflation going up, but I think a necessary stimulus will be some fiscal loosening or some budgetary stimulus from the administration in the US. In the meantime, we have a very benign investment environment. We have a decent economic growth, we have low inflation, and we have very loose economic monetary policies. So let's enjoy this.